Just a day before the budget, India's economic survey has been presented in the parliament. It expects a real GDP growth of between 6.5 to 7%. There are challenges on the horizon as well. What does India Inc. think of all that? We are joined at this moment by Mr. Sanjiv Puri, President CII, to talk all that and much more. Well, thank you for talking to us, Mr. Puri. Let's begin by talking about the real GDP growth that has been projected of 6.5 to 7% in FY25. Is it better than, is it lower than your projections? What do you think about these GDP growth numbers?
First of all, thank you for having me on the show. So yes, it is in fact, we would believe a little cautious, and it's good to be cautious because it may impact the way we forecast revenues, etc. And even if we look at RBI and global institutions have recently updated, RBI is standing at 7.2%. CII believes that the potential is 8%, and it believes so because of a number of factors, including the fact that we believe agriculture, sector is expected to better because so far the projections for the monsoons are better. We also do expect that the services sector will do better. Particularly, we are hoping that in the second half, later part of the year, we may see some better discretionary tech spends globally. So the services sector should also do better. Even global trade is supposed to be, which was on the negative territory this year, is supposed to be on the positive territory next year. So all these are positives. And as far as inflation is concerned, we potentially should be doing better because the only sticky part right now is food, and it's quite sharply correlated to monsoons, which so far indications are positive. And once the food inflation also moderates and overall inflation is more moderate than previous years, we do see interest rates also easing in the later part of the year. So all this, I think these are the factors that we are seeing, that we are saying that the potential is actually perhaps to do better than what has been forecast in this survey. Even as I said, RBI is sitting at 7.2, and there are the global estimates at 7% also. So we should do better than what is there in the survey. That we are fairly confident of.
So the survey also says it is time for the private sector to take the baton on capex. How do you see this particular comment, and what about the pace of investments from the private sector?
So I think the survey very clearly acknowledges that private sector investments have been going up. It is now, if we include household and private, enterprises together, or even both, we look at it separately, both have been going up and are above the pre-COVID levels. And the internal surveys of CII indicate a lot of optimism. Capacity utilizations upwards of 75% in many sectors. And then there are many sectors, that have tailwinds in India and globally, whether it's a renewable sector, digital transformation, whether it's hospitality sector. So many sectors will see investment. So the survey, I would say, acknowledges it. And I think the investment we expected should continue. The survey, in fact, rather puts a bit of caution, and I think the caution is on very solid grounds, fundamentally on account of the external sector, basically cheap Chinese imports getting into other parts of the world, including India. That does remain a risk, and there have been cases which we are within the membership. We've got to know where certain investments had to be delayed because of this impact of some of this cheap Chinese imports. So we do need to look at better mechanism to deal with such cheap imports coming in. We do have this system of dealing with it through anti-dumping, but can there be a faster way of response on some of these? I think are certain things that need to be examined. But otherwise, I think we are on a positive momentum, and with further reforms and focus on, and what CII is recommending, providing impetus to sectors that have higher labor intensity.
If you like this video, then like, share and subscribe to ET Now.